Return on equity bridges the gap between the income statement and the balance sheet to derive at its value. It is the net profit from the income statement divided by the equity in the balance sheet. How you can think of it is the company's return on its assets. Because if the company has assets and are not using them to generate income, it's better you liquidate them. But return on equity shows what the returns are from utilizing their assets in the form of a percentage. So let's say I have a company and the net income is $1 million and the equity is $8 million. The return on equity would be 12.5%. Understand that a high return on equity might not necessarily be a good thing, as companies can manipulate their figures. So let's say you have a company with 20 mil in assets, 12 mil in liabilities, and $8 million in equity. The net income for the company is $1 million, and as such, the calculation would amount to 12.5%. But let's say the company borrowed $1 million and bought back $1 million worth of its shares. Its liability would increase from 12 million to 13 million, and the equity would drop from 8 million to 7 million. Assuming it's the same $1 million in net income, the return on equity would become 14.3%. So you can see it's higher, however, no real value was created from the assets. The reason why this is a great metric to use is because it doesn't measure the stock price but measures the company actual performance. The best way to gauge ROE is to compare it to companies that are in the same industry. So if it is a bank, compare it with other banks' metrics. And I also have an Excel sheet for all the different companies listed on the JSE. If you're interested in something like that, just hit me up on Instagram. The thing is, you want the company return on equity to be close to the industry average. So you don't want something that's too high because it might be too risky, and you don't want it too low because it might be underutilized its assets. However, if a company maintains the same assets and the same set of liabilities and the return of equity increase, this means that the company assets are being used more efficiently to generate income. But as Warren Buffett said in his 1977 letters to shareholders, to be aware of companies with strong return on equity as well as high debt to equity. And it makes sense, as high return on equity and high debt to equity just simply means that the company return on equity is most likely higher from more debt. And that is it for return on equity. Just remember to smash the like button for the YouTube algorithm, subscribe. Love you guys. Peace.
A good business is the one that earns a high rate of return on tangible assets.
Very simple.
That's pretty simple, yeah. And the very best businesses are the ones that earn a high rate of return on tangible assets and grow. But even ones that don't grow, if they earn a high return on tangible assets, and then of course if you don't pay too much, they can be a good investment. They're a good business to start with by the high returns. If you pay too much for them, you can turn a good business into a bad investment. But if you pay an appropriate price, you can do all right.